Well, welcome to our first time homebuyer webinar. Thank you very much for joining us. My name's Darcy Wheeler. I am the broker owner of Asset Management Real Estate. I have been selling real estate since I was 19 years old. I am a true lifer. I love what I do. I love this business. I absolutely love working with first-time buyers. I get a lot of satisfaction and reward out of helping people through their first purchase and educating them through this very complicated but amazing process. Shar, who's not with us tonight, as I mentioned, is my preferred mortgage lender. I've been working with Shar for many years. She's also very, very exceptional at educating people through the first time they purchase. And also with me is my co-host, Melody Stiles.
Hi.
If you don't know Melody, she is my administrative assistant. She is my marketing guru. She is the data and statistical genius behind a lot of the slides in this presentation, and she is just amazing. So welcome, Melody. Thank you for being here.
All right, let's get going. All right, these are the topics we're going to cover today. Darcy, go ahead.
All right, so renting versus owning will be the first thing we cover. The second thing will be how a mortgage works. The third, down payment and mortgage insurance, closing costs and expenses, and credit, which is a very important part of the qualifying process, and a general overview of these steps. All right, so renting versus owning. A lot of you with us today are currently renting, you're considering owning, and we wanted to discuss the benefits of both because each does have its benefit. So when you are renting, as you know, you do not have to deal with the maintenance personally. The landlord typically takes care of the maintenance. If anything breaks, the landlord will fix it. Short-term flexibility, meaning that you can move around every year. You can go from place to place, or you know, shorter term if you'd prefer. Some rentals are all-inclusive, meaning that the owner pays for utilities, yard maintenance, etc. You don't have to plan very far ahead. You can typically find a new rental in a few weeks, and there's less upfront cost, usually just first, last, and security. And then home ownership, yep. Home ownership provides security and stability. So the nice thing about owning a home is once you establish your mortgage payment, you're not going to have too much transition with that. And also, if the owner of a property that you're renting decides they want to sell, now you have to find a place to move. So when it's your own property, you're not going to be under those same regulations. Payment is relatively fixed, which I just mentioned. More home for your money and less monthly costs. So right now, with the way interest rates are, you can buy more house and get a better property than you can just renting. You gain appreciation, not the landlord. So you're also going to make money as you own the home over time. And it's one of the easiest ways to gain financial freedom. More millionaires have been created in the United States through real estate and any other investment vehicles. So it definitely will help you level up. So now we have to consider what are your priorities and look at some data.
All right, I'm going to jump in here. We're going to go over some just charts and graphs that represent local area data. The first one I want to go over is what the average rent gets you in St. Petersburg. This is a chart based on specifically St. Petersburg. The average rent is $13.76, and the average apartment size is 871 square feet. So if you think about what a mortgage might be and what you're getting for that mortgage versus what you're getting in rent.
Yeah.
Also, something important to note here is that YOY, year over year change. That's 7% in St. Petersburg. Nationally, rent increases 5% per year on average. In St. Petersburg, it's a 7% average, and you'll see here in a minute that it's sometimes above 9% in 1 year rent going up.
Yep, rents are definitely increasing. We've all seen that.
All right, let's see here. This slide is demonstrating the same thing. Basically, what I want you to take from this is that it doesn't matter what type of property you're looking at, studio, 1 bedroom, 2 bedroom, 3 bedroom. The trend is that they're all going up. The rent is rising no matter what type of rental property it is.
Yep, if it's a studio, single family, they're all going up.
Great.
This is your stat.
See here. Yeah, can you check on this while I'm finishing this one? Awesome. All right, if you look up at the left-hand corner, this rent range, if the golden color is rent ranges that are between $1,000 and $1,500, and the green is $1,500 to $2,000. So that is between those two, $1,000 to $2,000. That's almost 75% of the rental market paying between $1,000 and $2,000 per month for rent. and not getting anything out of that. So that's the main thing that we're going to kind of transition into talking about. Look over at this second chart for rent trends. This is similar to what we just looked at. That red line is your national average. And you can see that it's not quite as steep as the St. Petersburg line, which is blue. St. Petersburg is going up at a higher rate. It is currently a lower average, but with that incline, we don't know how that's going to play out later on.
A lot of people moving to the area.
I have somebody in the waiting room. Go ahead and.
Hi, Jen.
Jennifer. Welcome. We just got started, and we will be recording this, so you can catch up with us in a little bit on the very beginning of it too. Glad you made it. All right. So the next slide. Okay, this is an article I found, a recent article, and it's about average rent increasing more than 9% in 1 year. Now, we just talked about St. Petersburg was already at 7% average, higher than the national average of 5%. But this is the kind of increases you could still potentially see in our area.
Yeah, if you've rented in St. Pete in the last 3 years, you know that rents are going up. I love this slide because this explains very clearly the benefits of having a mortgage and having a fixed payment versus being exposed to rental increases over a 30-year term. So the bottom line in blue, that's if you had a mortgage that started at $1,036, it's going to stay relatively the same. It might fluctuate slightly with difference in taxes and insurance, which we'll talk about, but it's not going to go up to double what the payment that the renter is paying 30 years from now. And this is based on a national average, so it could be higher in our area. But that is one of the benefits of homeownership is you lock in your payment, you lock in your expense. So that can benefit, especially as your salary increases and you have more ability to save and plan for retirement.
All right, great. Let's see here. Okay.
I like this slide.
I do too.
Yep.
On the right, the median asking rent, that's just basically summarizing everything that we've already mentioned. Since 1988, rent is going up, and it's just going to keep going up. And we'll discuss why later. But looking at the other slide, I like this one because it's kind of a long-term window. If you are a long-term homeowner versus a lifelong renter, I mean, look at this, a difference in 65-year-old adults. So you reach an age where you're about ready to retire, you want to do fun things and go all the places you wanted to go, and you've been a renter. How much have you saved? What is your net worth? It's about $6,700. And looking at the homeowners, and I think that this is actually kind of a restrictive slide. It's underestimated. This homeowner who has home equity worth above 140 grand.
Yes, just by making their monthly payments and maintaining their property.
Right. And you might say, okay, well, that's not cash in the bank, but it could be. If they wanted to sell their home, they have cash in the bank. So it is still an investment, and it is still a worth.
Yes. And the nice thing about real estate is it's one of the few investments that you can leverage. So if you do have equity in your home and you need cash, you can get typically an equity line or refinance or access that cash if you need to without having to sell your residence. So that's another thing a lot of homeowners take advantage of to pay debt, get out of debt.
Yes. Okay. These two graphs are practically the same thing. They're just set up a little bit differently. Visual preference.
Investment.
Yes, best long-term investment by far is real estate. So your cash investment, you're going to get more return out of real estate than you will stocks, a savings account, or even gold. And it's not a little bit. If you that's up there, 35 compared to 21 at the closest.
Well, and this goes back to leveraging too, because most people can't take $100,000 out of thin air and invest it in the stock market, but you can take $100,000 out in a mortgage and invest it in real estate and let it grow.
Yes.
So that is one of the benefits of a leverageable asset.
It's essentially letting somebody else's money make money for you.
Absolutely.
All right, and moving on.
All right.
These are our last two graphs. The first one is basically just going over that savings. It's accumulative. So if you look at year 1 all the way to year 30, we're adding those up. This example saved almost 200 grand in 30 years. So that's from having a steady mortgage payment versus paying rent, which is not steady.
Yes.
And then to the right. So that's the savings aspect of it. But if you look over at the other chart, that's going to talk more about appreciation. And as you can see, it's been a relatively steady trend going up. There was
Just a
that
little bump.
2008 bump, but
Thank you, Wall Street.
the rest of it is nice and steady.
Yep.
And there's no reason to see why that trend wouldn't continue.
And on the left, that graph, the reason why they're saving more every year is because they're paying more down in their mortgage. So every monthly payment you make, the next month you're paying more towards your principal. So over time, it becomes just a savings account for you in essence, plus the appreciation. So.
I think my computer's loading a little slower today.
That's all right. At least it's not taking off. All right, so wrapping up, renting versus buying. So why do investors own property? Investors own property because it makes money. And when you own a piece of real estate and you have a tenant paying half of the rent or all of the rent, that covers your expenses. In some cases, you make a monthly or annual profit, and you also realize that value appreciation. So the tenant is taking the financial burden, and you are reaping all of the benefits of owning that property. And as a homeowner, you can have a residence that can produce income, or you can live in it and it will still make you money because you're not paying the rent to someone else. And like we mentioned, in real estate investing is a way to level up and make more money. I have an example. I have a client who is a school teacher, and I met her in 2011. I sold her a very small starter home in St. Pete in an area that has become very up and coming. And it was 2 bedrooms, 2 bath. She rented one of the rooms to a friend of hers through pretty much her last term in college and part of her middle 20s. She's since gotten married, and her husband bought another home in St. Pete also, and they bought that in 2017. And we met a couple of weeks ago. They want to buy a third home because now they have a family and they want a little bit more space. They want the pool. They want some other things, especially since they're working from home. They need more room. So we looked at the value of both the properties that they bought. The one that she bought in 2011 is almost going to net her $200,000 in proceeds from what she's paid down in her loan and what she's earned with equity and some of the improvements she's done. The house they bought only 3 years ago is going to increase almost $125,000 in value. So they have $325,000 that they're going to be able to either access by selling those properties, which they're probably only going to sell one, and roll that equity into a larger home that might be their forever home, their dream home.
Yep.
Which really is amazing because it's been less than 10 years they've been able to do that. So
I love this idea of leveling up, and I've definitely seen it in my personal experience with owning a home too.
Yep.
Just being able to do more for my family as time goes on using real estate.
Yeah. No, it's definitely lucrative. And it is a little, you worry about the renters and things like that, but that's what we're here to educate you for. And for the most part, it works. So types of properties: single family residence, which is just a house, typically one family, or if you're, in the mind, you can have roommates. Multifamily is where you have a 4-unit or less. So you can have a duplex, a triplex, or a quadplex, and it's still considered residential real estate. A condo, which is typically a box that has shared ownership in an association. So you have an additional monthly fee that pays for the condo association. And then a townhome and a villa is similar to a condo, but you typically own the ground below you. So that's the difference between those two, is how it's deeded and vested.
So the condo's just between the walls, and the townhome is the entire piece of
Correct.
property.
A condo, you basically have percentage of ownership in the association. A townhome, you typically own some of the land.
Okay. That makes sense.
Yeah, and there's different financing types for condo and townhome. So how a mortgage works. So when you make a mortgage payment, you are paying 4 different parts. The first part is principal, which is the money that you borrowed, your initial amount of your loan, which you're paying back in installments. Interest is the money that you pay to the lender for borrowing that money, and that's often calculated as a percentage of the loan. Property tax goes to the municipality for roads, infrastructure, schools, that goes to the county. And then insurance, which you have so that you have safeguard in the event that there's a repair or damage or liability or some claim against the property, and you can make that against your insurance and have some coverage.
Right. Homeowners insurance specifically on that one, and we're going to talk a little bit more about that here in a second too. Taking that acronym that Darcy just gave you, PITI, principal, interest, taxes, insurance, that's how a mortgage works. That's what is involved in a mortgage. We're going to apply that to our own little case study so that you kind of get a better idea of what that looks like within a mortgage. So we have Jordan and Taylor. Jordan and Taylor buy a home for $250,000. and they get a gift from Great Aunt Sally, 5% down.
Thanks, Aunt
payment.
Sally.
Thanks, Aunt Sally. And that's $12,500 towards the cost of that home, which means that their loan is $237,500. They have a 700 credit score. The rate is 3.25%, APR is 4.216, and the term is a 30-year loan. So we're going to use that PITI and break down the mortgage payment. Now, typically you see principal and interest grouped together when you're talking about specific numbers, and that's because each month the base mortgage, the base
principal
interest rate.
Yeah, the principal amount is going to be every mortgage payment. You pay a little bit more towards principal. So when you start your mortgage, you're paying maybe a few $100s, and when you end your mortgage, the whole payment is towards principal.
Right.
So they collect their interest up front.
But the total amount of principal and interest is going to be the same. So
Correct.
Part of that sandwich will be towards principal,
Yes.
and part of that will be towards interest. That's going to fluctuate and change.
Correct. But the
the
PI
whole
payment never changes.
Right.
Yes, that 1,040 will be there for the 30-year term of the loan.
Perfect. So using PITI, their principal and interest is $1,040.14. Now that's based on their particular scenario. So we're using them as this little study. Their taxes are usually at an annual rate. So what we do is they're going to divide that by 12 and decide to figure out what the monthly rate is.
Yep.
Their taxes are $225 per month based on $2,700 per year. And the insurance is $125 per month calculated at $1,500 per year.
Yep. And those are realistic for that price range in Pinellas County.
Right. So looking at their subtotal without any additional considerations, without talking about PMI, we're not getting into that.
Mortgage insurance is not included in this, but their payment would be $1,390.14.
That's right. All right.
Which is cheaper than you could rent a $250,000 home for.
Now that first slide, I'm curious. It was very close to what our slide said for the average rent. $1,376 for the average rent in St. Petersburg. That gets you an 870. You have that memorized.
An 871 square foot apartment or half a duplex. I mean, realistically,
yeah,
we have apartments that we're renting for, $1,500-$1,600 a month, not even a house. So yeah, $250,000 home would probably rent typically for $1,650 to $1,750.
Because you're paying for flexibility. You're paying for not having to know what you're going to do next. All right. So the P, Darcy talks about P, it's for principal. That's paying back the money that you have borrowed. It's one part of your mortgage payment.
Yep.
And this is the actual chunk of money that you borrowed. So if you receive a bonus at work and you choose to pay an extra $500 towards the principal of your loan, it doesn't go to the other parts of your mortgage. It goes towards the principal, which is the money that you borrowed specifically.
Yep.
That's going to save you money in the long run.
Yep. And it can allow you to pay a 30-year loan off in 23 years if you pay one extra mortgage payment every year.
I love that example.
It is. It's a great example. So I is for interest. So if you look over on the left, those are historical interest rates on average for different decades. So in the 70s, 8% was the average. We jumped up in the 80s to 12%, 90s back down to 8, 2006. My first mortgage was 6.25%. And then now we're down to 2.96%. This is, insane, the rates that people are getting right now. I had a client lock a loan at 2.92 on last week, Friday. And I never in my career thought I'd see interest rates that low. So there is a huge advantage. You can get a lot more house for your money because of those low interest rates.
Right.
So on August 18th, the rate was 3.058 based on a 30-year loan. So what can affect rates, because they can change daily. You can get quoted a rate on Monday and it can be completely different when you go to lock on Friday. Factors that affect interest rates are your credit score. So the better your credit score, the better pricing you're going to get on a loan. The amount of money you put down can affect your rate. The type of property you purchase. So if it's a single family home versus a condo, that can affect your interest rate. The home price and the loan amount. If you borrow above a certain level, the rate could be higher, or the loan type can make the rate different. Loan terms, which is the amount of time. So if 20-year loan and a 30-year loan are going to have a different interest rate. We talked about loan type, which could be conventional FHA. And then economics is what's going on in the stock market and in the bond market specifically. All interest rates are tied to the bond market. So if something's happening in the economy, that can make rates fluctuate, such as a global pandemic. Yeah, exactly. We're all living through one. And there will be more. That's just the
Anything,
cycle of
storms,
economics.
elections,
Yep.
all of it.
Yep. So this is an interesting one.
I really like this one.
Yep.
So basically, this is saying that if your interest rate was 3.1% today, and in the fourth quarter it was 3.2, that doesn't seem like so much of a difference, 0.1%. But look at the difference it makes in the life of the loan by locking in at an earlier, lower percentage rate.
Yeah.
Almost $3,000 this person would save in the life of the loan.
Yeah, this shows you how the lower the interest rate, the more purchasing power you have because of the monthly.
It's great considering right now how low mortgage rates are.
Yep.
Okay. Taxes.
All right, so property taxes, this is a value that the county assesses on your home every year on the 1st of January. So they're going to create an assessment for your home. Your property taxes are calculated from that, and that goes to pay the municipality, infrastructure, schools. One thing that's really cool about living in Florida is our county, or not our county, our state has a homestead exemption, which means that once you buy a home and you register it as your primary residence, it's your homestead, the value, the assessed value of the property tax can't increase by more than 3% annually. So this really fixes your tax rate. It can fluctuate 3%, which isn't that substantial, so you can deal with it. But some of the properties that I'm selling, when the homestead is lifted, the taxes go from $3,000 a year to $7,000 a year because of those savings not being realized. So it's a really amazing factor. And if the property value goes lower, you get your taxes based on lower values too. So they definitely don't keep it at the same rate. It fluctuates, but you benefit because it can't go higher.
Right. And this was really created so that people could live more affordably.
Retirement. Yep. It was put in place so that it would protect people who are retiring here from other states from having that fixed income being disrupted by taxes. So insurance is a necessary thing. When you own a property and have it financed, then you definitely have to carry an insurance policy. Homeowners insurance is going to cover catastrophic damage such as house flooding from a water pipe, a broken water pipe, a tree falling on your house, a fire, liability too. So if somebody slips and falls and they want to go after your equity, your homeowners insurance would kick in and cover that. Hurricane damage, I know we don't want to talk about that right now, but that's another thing that it covers. Flood insurance is a separate policy, but you can insure for flood too if you buy in an area that requires flood insurance.
Right, and all policies are going to vary a little bit. But
yes.
This is something that you're going to need.
Yep, each house is going to have a little bit of a different base based on zip code and also on the roof and the type of construction.
Okay, so how long do you have to pay off your loan? There are a lot of different loan terms. The most popular are 15, 20, and 30 years. That said, there are some loans that will allow you to do like 8 years, but the shorter the loan, the higher your monthly mortgage payment's going to be.
Yep.
So looking at first-time home buying, it's pretty common to see people go with a 30-year term.
Yep.
The length of your loan term is going to influence your interest rate and your monthly mortgage payment. Things that you need to be thinking about are what can you afford? Will you be able to make extra payments? And is there any type of prepayment penalty on your specific loan?
Yep.
Because that's going to vary from one loan type to another.
Absolutely. All right, so there are several ways to fund a home purchase. So on the left, conventional financing, this is the most commonly used type of mortgage. So when people put 20% down, which is the number I think pops into a lot of people's head, that's typically a conventional loan. Conventional loans do offer lower down payment options, 10%, 5%, even 3% now in our current market. You have to have a little bit better credit. You have to have a little bit lower debt to income ratio. So you have to have a little bit more extra money than an FHA loan. So an FHA loan is utilized a lot right now, but the FHA loan caps at $331,000. So you don't see a lot of FHA loans outside of that price range. The nice thing about FHA, if it is your first purchase and you're within that range of borrowing, is the down payment is only 3.5%. That's the minimum. The interest rate is very low, but the mortgage insurance is a little higher. So typically conventional and FHA loans run hand in hand as far as pricing. It just depends on what your debt to income is and your credit score. FHA allows for lower credit and higher debt to income. A VA loan, if you are a veteran, this is absolutely the best loan product available to you. There's no money down requirement. There's no mortgage insurance, even if you go up to 100% financing. There's no prepayment penalties. The interest rates are typically the lowest that we see. VA loans are absolutely a phenomenal benefit of having any military service. USDA loans don't apply so much in Pinellas County, but this is more of a loan product that's designed for rural areas, encouraging people to buy in rural areas. And it's similar to VA in the sense that there's no money down needed, no prepayment penalties, low rates. But that's not something, if you're buying in Pinellas, you'd probably run into, but it might be in your area if you're outside of our county. And then, of course, cash. You can always pay cash for a home if you like.
I have a question about the FHA. Now, correct me if I'm wrong. Is that the one where if you buy, let's say, a quadplex and you decide to live in one because it's owner occupancy only?
Yes.
But then you can also operate as an owner and rent out to other tenants.
So investment-minded buyers out there, FHA has a loan product that is very, very unique. Conventional doesn't offer this. If you were going to buy a 2-unit or a 3-unit or a 4-unit property, conventional financing, you'd have to put 25% down, maybe 15% if you're going to occupy. FHA will let you get into that property for 3.5% down, and the loan limits, that 331, does not apply when it's a 2-family, a 3-family, or a 4-family. They tier up. So you can go up to, I don't know the number, but it's $450 for a duplex, $550 for a tri, and upwards of, I think, almost $600,000 or $700,000 for a quad.
That's great.
In Pinellas County, because those change per county to the maximum loan amounts. I've had a few clients, and I wish I would have done this when I was in my early 20s, but I have a few clients who have, been single, and they have lived, in one of the apartments, qualified FHA, and gotten into this property 3.5% down, and now we're cash flowing. And their tenants are paying their entire mortgage. And if they decide to level up and move into another property, then they have it, and they have a retirement income producing asset. I know. And not a lot of people know that FHA can do multifamily.
I think
so.
Yeah. I think Shar had mentioned that.
No, it's a very unspoken about loan product.
All right. Let's talk about down payments. As we just saw, down payment requirements can vary depending on the type of loan you choose. So different loan, different down payment requirements. Some have no down payment requirements.
VA.
But it's important to know that in some instances, conventional, if your down payment is less than 20% of the cost of the property, that loan might require something called private mortgage insurance.
Yes.
And it sounds kind of scary, but it's not.
It's not.
It's just a little addition added to your monthly mortgage payment. And this just helps reassure the lender that you're covered.
Yes. So if you don't pay, then the private mortgage insurance company pays the lender up to that 80% of the loan value. So it's the lender's assurance that they're going to get covered and they're going to be protected.
Right. So if you have a down payment less than 20%, you pay PMI.
Yes.
If you have a 20% down payment, you don't pay PMI.
Yes.
There are certain loans that it will be dropped when you reach 20% of your loan paid off.
Yep.
Some other ones, depending on the loan, might say that it's for the lifetime of the loan.
Yep.
So you want to definitely look into that when you get towards that side of it.
And it's not that expensive. It's just the cost of putting less money down. And sometimes it makes more sense to keep the money in your pocket.
Yep.
So
how can you prepare for a down payment? Sometimes they're gifts from family. Sometimes you save up for them the same way that you would save up for last month's rent and security deposit, which can also be fairly steep.
Yep.
You might qualify for a loan that does not require a down payment, especially if you're active duty or a veteran.
And a gift from a family is a great way to get into your first home too, if you have that flexibility and you have someone who would give you a loan or give you a gift to pay that cost.
Right. All right. So just a little bit more about PMI, private mortgage insurance. Like we said, it helps protect the lender from loss if you default on the property for any reason. Depending on the loan, so these are the 3 points that I want you to kind of take away about PMI. Depending on the loan, it may be required if your down payment is less than 20%. Often, it's a part of your mortgage payment, but sometimes you might have to pay that upfront at closing.
Which you finance into the loan amount.
Yes.
So you don't have to come out of pocket with it.
Out of pocket.
But it's an additional upfront expense, and then there's a monthly expense as well.
Right. And then monthly PMI varies by the loan program, but it's calculated by debt ratio and credit score.
Yep.
And usually it ranges between the percentages of 0.5% and 1.75%.
Yep.
So that's kind of the basics about PMI.
Not anything you have to worry about. The lender will tell you what it'll cost.
We're going to apply it to our case study here.
Yes.
Because that's going to be
it
their
changes the
mortgage.
payment. Yep.
So Jordan and Taylor, we said that they chose to put down 5%. And they went with a conventional loan. That means that they qualify for having to pay PMI because they could not put down the 20%. No big deal. We talked about their their PI as their
Yep.
yes, their principal and
Principal and
interest
interest.
at $1,040, their taxes at $225, and their insurance, homeowners insurance at $125 per month. So their subtotal that we discussed earlier was $1,390. Now at 0.59% PMI, and this was run as if it was
This is
an
a real
actual
scenario based on a 700 credit score.
$116.77 was added to their monthly payment. So their total mortgage payment is $1,506.91.
Yep. And one thing to keep in mind too is a portion of every $1,506 payment goes towards your principal balance. So if it's $320 per payment, you're putting that back into the equity in your home. So really, if you look at the numbers that way, you're taking that off the payment and you're only paying 12 and change.
Yeah. It's a savings account, no matter how we...
1180. All right, so affordability factors when it comes to interest rates. Credit score is the predominant factor that lenders look at in determining your pricing. So credit has some tiers. Anything under 629, it's going to be very challenging to find a mortgage lender, even though FHA will advertise that the minimum credit score is 580. A lot of the lenders that are actually loaning the FHA funds have overlays, which will require a minimum of a 640 score right now. So in the fair range where you can still qualify for a loan, but you're not going to get the best pricing is that 630 to 689. Good credit is considered 690 to 719, and excellent credit is 720 to 850. I have a story. When I refinanced the house that I'm in now 4 years ago, I didn't have a lot of debt at the time, so my credit score had gotten lower because I wasn't borrowing a lot of money, and I had to actually use a credit card, buy something with it, and my credit score went from 7 and change to the next pricing tier. So when you have credit that's capped at a certain number, it's important to look at why your credit score is there, and there might be factors that allow you to increase your score that you could do very easily, like buy something. And Shar, and unfortunately she's not on the call to talk about this tonight, but she is a guru at repairing credit and also showing you there's a credit scoring report you can pull that will tell you exactly what you need to do to increase your score. Sometimes it's very simple and you can jump from one pricing tier to the next, and that's why it's a good idea to talk to a lender well in advance of deciding to buy, so you can make those adjustments to your credit and make sure that you have the ability to get the best possible rate.
One second, I'm going to check. I think I've got something in our chat here.
Oh.
There we are. What are good debt to income ratios for each type of loan?
Okay, so when your debt to income ratio, the maximum that you're going to be able to get approved, and this is a great Shar question, 45% is the high end, from what I understand, on an FHA loan. Anything, you might get a little bit above that, but when you are nearing that factor, they're probably going to deny because it's too much debt. If you can stay under 40%, that's fantastic. You're across the board going to qualify. FHA will allow you a little bit of flexibility. VA probably will too, but 45 that's the red line, to my understanding. Shar could give you a little bit more information on that too.
All right, awesome. And just a little recap on Jordan and Taylor, case study, their credit was 700, so that's going to fall in the good range.
Yep, that's a great credit score, and you can get a great interest rate with that, but you might be able to do something simple and increase it.
Right, so let's look at why
you can't get a loan
applications are rejected. And what I want to stand out to you here is credit history is almost 30% of that. That's a big deal.
It's a big one. And debt to income ratio. Thank you, Sid, for bringing that up. It's a great question.
So talking about credit score and that being a variable.
Yep.
Let me pause this, go back.
Yeah, so there are ways that you can repair your credit score. There are ways you can bring it up. And sometimes it can happen very quickly. They can rescore you within 30 days.
Oh, yeah.
So it doesn't have to hold you up for years or a long period of time.
So these are some things that you can do to help repair or increase your credit score. Pay your bills on time, keep your credit balances low.
Yep.
You want to pay off debt instead of moving it around. So don't take a credit card to pay a credit card.
Yep.
Just pay it off if you can.
Yep.
Apply and open credit accounts only as needed.
Yeah, you don't want to have a lot.
Yeah.
The really 3 to 5 is the maximum number of credit accounts you should have. As far as credit cards, if you have a car payment or some other type of credit, student loans, it's outside of that, but they don't want to see a lot of credit cards.
I think that said, they like at least 2, right?
At least two, yeah. Three, I think, is the magic number. And they don't want to see you close them all. So before you make any changes to your credit profile, talk to somebody who can advise you correctly. Because if you've got 10 and you're like, oh crap, I don't need 10, maybe I should lessen them. When you start closing them, that can affect your credit negatively too. So there is a balance there. It's very tricky, this credit reporting.
Right, and it's all numbers and computers as well. So make sure that you check your credit report for errors. There might be an error, you can dispute that and get that corrected. But the last thing on here is probably one of the most important. Do your rate shopping within a focused time period.
Yes, so don't let multiple mortgage companies or even multiple credit companies, if it's a car shopping or any kind of shopping that you're doing, pull your score at the same time, because that will drop your score on average 8 percentage points per pull. So you want to do it once.
All right, let's take that monthly payment. We're going to break it down and recap. Or twice. We're going to break it down one more time for our case study. PITI, we talked about that. PMI, we talked about that. So that is your mortgage. Here we are, Jordan and Taylor. Now, these are two different scenarios for the same mortgage, except one, they put 5% down, and the other, I guess Great Uncle Bob has an extra 15%, and now they've got 20% to go down. So originally, you might look at this and be like, well, whoops, hold on, I lost my screen. Why is the first case study for 5% down have a lower interest rate? But what I want you to focus on here is that APR, because that percentage rate is going to reflect having PMI in there and the extra stuff, the extra considerations that need to be dealt with. So 4.216 versus 3.55
is substantial. Yeah. And the APR, you'll see that a lot on your mortgage application. Annual percentage rate is the total cost of getting your loan, including your closing costs, and in this case, mortgage insurance calculated as a whole versus what the actual note rate is, which is that 3.25%. So it is, I mean, a whole percentage point higher because of the mortgage insurance. So putting more money down is always going to be cheaper.
And when you think about that in terms of the 0.1, the graph that we saw earlier where there was 0.1% difference, and that you can see it $2,700 in the lifetime of the loan. This is a whole percent.
$280 a month.
Right.
Now that mortgage insurance, once you pay the mortgage down so that you are in that 20% down position, that mortgage insurance falls off. So if you have no other choice but to get into it with little money down, eventually you're going to be back at what the right-hand scenario is, because the mortgage insurance will go away, and that will factor into your payment.
Yep. We did that.
Yeah, I've refinanced to get rid of it too. Yeah, absolutely.
And looking at that 1506.91 as well, like it maybe it looks big compared to the 1225, but when you think of 1506 and what we rent out properties for at 1600 or 1900, what you can get for 1506.
And then remember that a portion of your principal is also going back into paying off your original loan balance. So you're saving a portion of every one of those payments in that PI section, the 1040 section, in what you're paying off your loan balance with.
Right. Okay, so let's compare these real quick and we'll move on to the next slide. Principal and interest at 5% down, that's $1,040 versus $875 at 20% down.
Yep.
The taxes and insurance are going to stay the same. That's not going to change. So we've got $225 and $125. And then PMI, you're not going to have that for the 20% down. So that's where you get the differences between the 1506 and 1225.
Yep.
All right. And then there's a little note on here as well, just to kind of take a look at that APR. It's going to reflect the extras like PMI, which is why the second case study has the lower APR.
Yeah.
Which we covered that.
You did such a nice job on these slides, didn't she? She's awesome. All right, so affordability and closing costs. So when you close your purchase, you're going to see this list of all these random charges. You don't necessarily need to know what all of them are specifically, but there are costs associated with borrowing money and buying a home.
Taxes.
So type taxes. So title fees, title insurance is provided by a third party called a title company or a closing attorney. And what title insurance does is it's a research that the title company does to when the property was essentially built. They make sure that nobody has an ownership claim, that there isn't a mortgage or a lien that's unpaid, and they actually provide you with an insurance policy so you know when you're buying a home, you're buying a clean title. The title company also facilitates the closing. So as a mortgage lender, they're going to send a portion of the money to the title company. You as a buyer are going to send your down payment to the title company. The title company is then going to disperse that to the seller, to the real estate agents for their fees, to the mortgage company that the seller had to pay off their loan. So the title company facilitates all the money as well. They're a very important part of the transaction.
I kind of think of them as a conductor.
Yeah. Yeah, it's the mediator, it's the settlement agent. That's another term that's used a lot, is they're the settlement company. Loan fees are also going to come up on that fee sheet. So you're going to pay taxes, unfortunately, on the mortgage. You're also going to pay origination fees. There are fees associated with borrowing the money from the lender. Most of those are nominal, but the taxes are a big one. Survey fee. Escrows and prepaids. So when you buy a home, you typically pay your first year of homeowners insurance up front. So that's another closing expense. You pay a year up front, and then you make that monthly payment to build up the premium for the next year because it's paid on an annual basis. Third party fees. So I am a big proponent of home inspection. That's something you should get done. And when you write a contract, we do the home inspection as the first part of the purchase. So that's going to be a fee that's paid outside of closing, but it is still part of your closing costs. And then appraisal fees. So over here is a case study for Jordan and Taylor at their $250,000 purchase. They had $1,275 in title fees. They had closing costs, which is part of that tax, the taxes on the mortgage we talked about, and the origination fee, their escrow and prepaids. That's building up their escrow account with the mortgage company, because when you're borrowing money, the mortgage company wants to make sure you're saving enough to pay that tax and insurance annual renewal. So they take a little piece of every payment and they put it in their own account, and then they pay it on your behalf. But when you start, they take a few months extra, so you always have a small surplus. The home inspection fee, that's paid to a third party, and you pay that outside of closing. But that's to make sure that there's a good roof, good plumbing, good electrical wiring, and that there's no termite activity, which is a big deal in Florida. And then a wind mitigation, that's another inspection we do to get you cheaper insurance. The better your roof system, the lower your annual insurance premium and the less your payment will be. Appraisal fee is also another outside of closing fee that you pay up front. You typically, if your closing costs, which that $37.27 includes it, you get it back on the closing statement, or you bring that much less to the table. But inspection and appraisal are paid out of pocket while you're purchasing, and everything else is paid at closing. One thing that is amazing that we can do is we can get the seller, if we write a contract. So let's say Jordan and Taylor make an offer of $250,000, and they know they're going to have $6,800 in closing costs. We ask the seller to accept an offer where the seller contributes $6,852 towards Jordan and Taylor's loan costs, which would allow them to get into the property with only the 5% down. The banks let you do that. The sellers, most of the time, are willing to work with that. We basically roll it into the purchase and roll it into the loan. In addition, if you have a family member that will give you a gift, you can also use that to put your 5% down or your 10% down or whatever kind of gift you're working with if you didn't have the money up front. So you can take some of this large figure expense and lessen it by rolling it into the transaction.
Awesome. And really, before we get started on this slide, I just want to say that the $6,852, I was thinking if you had a $1,600 property,
yeah,
and you needed first months in security, that's $4,800, which is not too far off from closing.
And then if you have a pet, we're going to ask for another $500 or more in pet security. Yeah. So the amount of money that it takes to move around, if you buy and negotiate the right contract, it might not be that much more to get into a home to purchase. So when you're buying a home, there are going to be other considerations, other expenses. One, furniture. Everybody wants to furnish their place and get a nice, layout and design. Appliances, the washer and dryer might not be included in the sale. You might want to upgrade your kitchen appliances. So that's all something to think about. The cost to move. We've all moved. We all know that there's an expense to rent a truck, or if you're lucky enough to hire someone, that's expensive. So that's something to put into your budget. Utility hookups and deposits. Duke wants their money. The city wants their money. Everybody's going to charge to set up your utility accounts. I'm a big proponent of making sure you have money set aside for a worst case scenario. If you pop off 4 tires on the freeway, God forbid something happens and you have to go to the hospital and you need to have some extra emergency cash, it's definitely something to think about before you buy a home, is having enough substantial, enough assets to substantiate that. Overlapping leases. A lot of times when people are trying to time out the perfect closing, you don't always get it to line up to the day before your lease expires. So you might have to pay a little bit of overlapping lease. But the nice thing about a mortgage is if you buy a property in the middle of the month, say I close in the middle of August, my first mortgage payment is not due until October 1st. Mortgage interest is paid in arrears. So I essentially skip September's payment. So if I had to pay rent for September, I'm not double paying because my first mortgage payment doesn't start until October. So that's a nice benefit if you are moving from one to the other.
Kind of helps with that breaking the lease thing.
Yeah, it can, because you don't think about that. You get a month for free, basically. Right. And then assistance and grants. So Pinellas County, there are some down payment and first-time homebuyer programs. The city of St. Pete has a program called the WIN program. It depends on how much money you make and how many people are in your household, because there are income limits. So you can't make a lot of money and qualify for these programs, but they are available, and it's definitely something to look into because it is free money and a lot of times it is forgiven. So that's definitely something that Shar, and I'm sorry she's not here to talk about it, but she's very knowledgeable about the Pinellas County programs. So
some things to think about if you're ready to buy your first home. Do you have that stable job, reliable income? Have you thought about down payment options, whether or not you want to try to go for a loan that doesn't require one, or if you have a lesser down payment? Do you have good standing credit, or do you need to work on your credit? And also, have you considered any other expenses that might be applicable to your situation? Are you looking for a more stable home, and are you a more financially secure future? Are you ready to invest in your own future instead of the property owner's future?
Yeah,
essentially.
That's exactly what it is. You're investing in you.
And if you are,
yes. So the first thing I would recommend is that you really take a good look at your finances and your budget, and you figure out how much money you're going to need to get into the property that would suit your needs. Getting pre-qualified is very important because you need to know where your credit's at. You need to know where your debt to income is at. You need to know what you're going to be able to buy so that if there's anything you need to do to remedy, credit situation, or to save more, or to figure out where the money's going to come from, you do that up front and you can start working towards that goal. I recommend, especially if it's your first home purchase, that you work with a real estate agent, because there are a lot of moving parts in the purchase transaction, not only the qualifying part, but the contract, the inspection, the appraisal, the title. I mean, all of that is in itself a big undertaking, and you want to make sure that you have someone looking out for your best interests and making sure that you're going to get into a contract that protects your legal side of the transaction as well. Wish list. So number 4, I love it when my clients present me with what their wants and their needs are as two separate things. When I know what your needs are, I'm going to make sure that the properties I present at a minimum meet those needs. If you have wants, then we kind of keep that separate, because if I look for a property that has all the wants and all the needs, there's going to be some opportunities you miss. So the less restrictive we can make that initial search, the more you're going to get educated on the market, and the more opportunities you're going to have that you might fall in love with a home that doesn't have all your wishes, but it's in the perfect neighborhood, and it's, just that emotional response to a house, which is a great way to buy a home that you live in. So that's important too, is to differentiate what are wants and needs. Next is we start searching, and that is getting set up with an MLS portal, which is our multiple listing service. That's where all the real estate agents share their listings. So you can start looking at what's out there, start driving neighborhoods, and really start educating yourself on the market as a whole, so that when you do find that right property, you know it's the one, and you know that you can make the right decision and get into your first home. And then structuring an offer. That's another part where your agent will guide you through. There's a lot of moving parts with an offer, and in the environment that we're in now, it's very active. So you have to put your best foot forward. You have to be ready to make a strong offer, and that's something that we can consult on and that your agent can help you with.
And then there might be multiple offers on a property.
We're seeing a lot of that right now. Yep, counter offers, and then time frames, and So once you get into contract, it's inspection, appraisal, closing, keys, and then you get your buddies to help you move in.
Home sweet home. Pizza party.
Yeah.
So real estate is one of the easiest ways to accomplish financial freedom. There is a learning curve. Once you get it, though, you're good to go, and everything just builds on itself. So like she said earlier, you take the appreciation and the value, when you roll it into the next one. Maybe your first home is not your dream home,
Yep.
but it's a good home to get started on.
Absolutely.
And maybe you're in a different place in 5 to 10 years and it's bigger and better because of the investment that you made.
And no matter what you buy today, it will always be worth more in 20 years. And if you're just getting started, just don't sell that first investment. Leverage it and buy another home and continue to grow your portfolio, because that's how you're truly going to become wealthy. So we would love to hear some questions. If anyone has questions, please type them into the queue over there. We have some prepared questions that we had from a couple of people who couldn't make it live tonight, so we're going to go through those as well. But yeah, please let us know what your questions are. So do you want to work from
All right,
the
let's
list?
Let's go ahead. How do I pay a real estate agent from Katie?
Oh, okay. So Katie, the way that you pay a real estate agent in our multiple listing service, when a property is listed with a real estate agent, the seller has already agreed to pay compensation to an agent. So as a buyer, you do not pay any commission. It's paid for by the seller. And typically we can always negotiate that into the purchase, even if it's a for sale by owner home. So as a buyer, one of the benefits is you don't have to pay commission and you get representation. It's always a seller expense.
Okay, and Joseph wants to know, what kind of things should I think about when deciding what area to live in?
Well, it depends on what phase of life you're in. So, if you like to bike, if you like to walk, if you want to be close to that urban, that downtown environment, that's going to drive you in one direction. If you have a family with school-age children, that's going to bring you on the other side of the county.
Right.
There's a lot of things.
Spending time in the car.
Yeah.
I don't.
Yeah, you don't want to have a location that's too far away from your place of work. Commute might be a factor. So definitely think about where you're at and what you like to do, and then look for neighborhoods that suit your needs from there. Type of home too, it'd be a factor of where you look. If you're looking for that investment property with 2 units, 3 units, 4 units, you might not find that in some neighborhoods. So that could be a factor as well.
Right. And then I think also maybe geological risks.
Oh, yeah, like flood insurance. Yeah.
Mm-hmm.
So in our county, any area that's near the coast, for the most part, is going to require flood insurance, which is an extra annual expense. It can be anywhere from $1,000 to $2,000 a year, which will affect your monthly base. Sometimes it's worth it to live in a great neighborhood. So you just have to decide what makes sense to you. If it's worth living in that neighborhood, you might want to pay the flood insurance. We also talk about other parts of Pinellas County, North Pinellas County, where sinkholes are a risk. That could be a factor too that we want to talk about before making a decision. So yeah.
All right, awesome. And then let's see what else we have here. What do I do if I don't have a down payment or the closing costs from Chad?
Okay, so if you don't have the down payment, you have the option to save until you do, and consulting with a mortgage lender up front so you know exactly what that down payment is going to be is a smart first step. You can get a gift, as we've talked about a few times, because I don't think people realize that a parent, a sister, brother, aunt, uncle, a familial person, it has to be a family member, can give you a gift towards your down payment, which could help you get into a property sooner. And then seller paid closing costs. We might be able to negotiate the seller to pay a portion or all of your closing costs. They can't pay your percentage down, but they can pay that additional closing expense and get you into that home faster.
Okay, awesome. Let's see here. One more from Katie. How long does it usually take to buy a home?
All right, so it depends on you. It depends on how long you want to look around and get educated and find one. We could start looking for a property, find one in the first 2 weeks. Some of my clients are more patient and they want to look for a different type of house that might not be available at that time. So that could take 6 months to a year to look around. But once you get into contract, meaning the seller has accepted your offer, you have a contract, closing will typically be within 30 to 45 days if you're getting a mortgage.
All right, I think that's all of these. Are there any other questions from our participants tonight? Nothing.
All right, well, that's all right. I guess we did a good job answering. It has been an absolute pleasure. Thank you for attending. I am so thankful to have the opportunity to host you. I am here if you have any additional thoughts, if there's anything that we didn't explain. This is very preliminary in the buying process. We didn't get into contracts or any of the other things, and I'm happy to discuss that on a one-on-one basis. And again, I really appreciate your time this evening and very happy to give you this information. I am a big pro home ownership person, if you haven't figured that out. I know it's made a huge difference in my own life, and I think it can. And everyone else's.
Yeah, definitely. We are also going to include Shar's information. She
Yes.
wasn't able to come
Yes.
for a family emergency.
But great person to start with if you are thinking about buying and you want to start by figuring out where your credit stands, your credit profile. If you call Shar, she can do it all over the phone, and she can tell you what your credit score is, what you can do to improve it, how much you're going to need to save to buy the type of property you want. And then if you're not ready now, at least you know what to work towards.
Right. And in addition to this, guys, I also want to encourage you to check your email. I sent you out an email earlier today. Basically, it has the slides from today, so all the information that we covered. It also has a little ebook about being a first-time home buyer. And then the third thing is from Shar. It is the 10 commandments of borrowing. That's what she calls
what
it.
Not to do.
Thou shalt not.
Yes, because once you are in the market for a home, you don't want to apply and take out any other type of loans or credit inquiries because the mortgage companies don't like that. So, yep, that's great information.
All right. Well, thanks so much for
being here. Yes, thank you so much for being here. Have a great night, everyone.
If you have any questions.
Yep. Have a great night.